This is pre-recording 15A, Chapter 15, Shareholders' Equity. So a lot of this chapter will be review, and we'll be focusing in class on some areas that may be new, but in this video I'll talk about the areas that you want to make sure that you know. So remembering our components of shareholders' equity and our statement of changes in shareholders' equity under IFRS, and under ASPE, our statement of changes in retained earnings. We're now going to start talking a bit more about some things that affect the contributed surplus account, and some of the items are listed here. We'll be looking at things that can affect retained earnings other than that net income and dividends. And we'll be doing that in Chapter 15, as well as in Chapter 21 when we talk about prior period error corrections that change opening retained earnings. We'll also look at property dividends, stock dividends, talk very briefly about treasury shares as well. And we won't be looking at adjustments due to financial reorganizations. We remember that preferred shares are a special class of shares, and not all companies have these, with preferential rights. So there might be priority claim on earnings and assets upon dissolution of the company. There might be assurance of a dividend before common shares, and they would rank ahead of common shares for bankruptcy. So there's a sacrifice here, maybe of voting rights, but to have less risk than a common share. So every incorporated company has to have at least one common share. And then there the number of different classes of shares, et cetera, that they may have could exist, and that's certainly optional. So we're going to look at some examples in class about a stated dividend or cumulative preferred shares and non-cumulative preferred shares. So some of the preferred share features might be the cumulative dividends, that dividends don't have to be paid, but they must all be paid, the dividends in arrears that weren't paid in prior years or prior periods must be paid before any profits can be distributed to common shareholders. They could be convertible to exchange for common shares. They can be callable or redeemable, meaning that they can be redeemed by the company on a specified date or at a specified price. They can be retractable, meaning the shareholders can sell their shares back to the company. And they could be participating dividends in that they share in profit distributions above a stated rate. And we'll look at an example at that in class. We'll also look at subscription shares as well, and what if the company almost does like an installment payment plan for shares, and this might be common with employees. So you wouldn't record common shares until all the shares have actually been paid for. So in the meantime, we'd use a common share receivable account and a common share subscribed account. And there's an example here on the screen that's the same as the one in the textbook. So once the amounts have been fully paid for the shares, then you remove this common share subscribed account, the share subscription receivable, and issue the common shares. Now, if there's a period end before the shares have been issued, then the common share subscribed account and is an equity account, and the share subscription receivable could be shown as an asset or reported as a contra equity account. So kind of showing common shares subscribed, less common shares receivable. So therefore, a nil effect overall on the balance sheet. Just like with debt issuance costs, our direct incremental share issuance costs are deducted from the proceeds directly from the common share or preferred share account. Annual costs for maintaining records, having a third party help us with dividend distributions, etc., would normally be charged to expense when they occur. So companies may buy back their own shares for various reasons listed here. And we won't be looking at accounting for a leveraged buyout. So once shares are reacquired, generally in Canada, they're retired. We'll also look in the Appendix 15A at certain provincial jurisdictions, and it's also very common in the US that you would have some treasury shares. So we'll look at just the basic, very basic accounting for treasury shares. So when shares are repurchased, assuming we're going to retire them, we're going to look at the average share price, the average price per share. So like the average cost, just like we would do with inventory. And that would be the amount that would be removed from the common share account, the dollar value. And then the difference between the assigned value coming out of that average value coming out of common shares, then we need to put it somewhere else. So if the acquisition cost is greater than the average of the share price per share, then we're going to, so obviously we allocate it first to the share capital, then to contributed surplus, and lastly to retained earnings. If the acquisition costs or the amount to repurchase the shares is less than what the amount is that's coming out of the share capital or common shares, the difference goes to contributed surplus. So it was like we had a gain. So here we're having a gain, we'll have a leftover credit, and that goes to contributed surplus. If we're paying more for the shares than the average price per share that's in the common share account, it's like we sort of like have a loss. So we'd first bring contributed surplus down to zero, but contributed surplus can't go into a debit position. So that's why then once contributed surplus reaches zero, then we take it out of retained earnings and we can reduce the retained earnings. Okay, this is specifically laid out in ASPE, and then in IFRS, this is what's generally done as well. So this will be how we'll do it in class. We can pay out cash dividends, or we could pay dividends in kind. So we could, this might be common, especially for private companies that maybe only have a couple of shareholders. We could pay out dividends of the company, of a company asset, for example, or the inventory, real estate, investments. So we would obviously value that dividend at the fair value of the asset given up. We could also have a stock dividend. So when you have a stock dividend, the shareholders still own the same amount, the same percentage of the company. And shareholders' equity dollar value doesn't change as a total. So there'll be an increase in the number of shares outstanding because each shareholder will receive a certain amount of shares, additional shares issued as their dividend. And then there'll be based on the market value of those shares, the value will be taken out of retained earnings. Companies could also do a stock split. And so there's no accounting that's needed as far as our general ledger goes for stock splits. We're just issuing more shares to the shareholders, and this is just a tool to reduce the market price per share that may make the shares seem more attractive to buy. So no effect on shareholders' equity. You'll notice in the financial statements that you will have the amount of authorized, issued, outstanding shares, any rights, preferences, and restrictions around the shares, and a reconciliation between the opening and closing balances of the shares. Any restrictions on retained earnings or dividends. And under IFRS, you'll see some more disclosure as well. Continuing on to Appendix A, which we'll do at a very basic level, looks at two topic areas, par value shares and treasury shares. So you don't see par value shares for companies incorporated under the Canadian Business Corporations Act, or CBCA, but you might see it if they're incorporated under the Provincial Corporations Act, and it's quite common in the United States. And basically, par value is just a nominal value that's been assigned to each share. It's usually quite a low value. And so if you have this par value shares, what happens in the accounting is you're still going to have the debit for the consideration that you've received for the shares. The common share account is just credited for the par value of each share times the number of shares issued, and the remaining goes to contributed surplus. So as mentioned previously, the treasury shares are created when a company repurchases its own shares but does not cancel them. And this is only allowed under certain provincial jurisdictions, and you see it in the United States. So what's happening, because the shares aren't canceled, They're still issued, they're just not outstanding. They're held in the company's treasury, held by the company waiting to resell the shares, and that's how they get the name treasury shares. So when the shares are repurchased, if you think that the company has had to, say, pay cash, so the credit would be cash and the debit is a shareholder's equity account called treasury shares. So it's a contra account, contra equity account. So at this point, because you're not planning to reissue the shares, they're going to it's like a holding account. And then once you actually sell the shares, then you'll account for any the difference, almost like your gain or loss. And at that point, when they're sold, you'll credit common shares with the average cost, like we talked about earlier. And the excess will go to contributed surplus, deficit goes to contributed surplus first, and then to retained earnings. Where if they don't have treasury shares, they'll do that adjustment right away, retire the shares, and then they'll have to reissue shares at a new price. And then that will be the new value that will go to common shares for those new shares that were issued. Dividends aren't paid on treasury shares. And here's an example of what the shareholders' equity section might look like if you have treasury shares. So you can see in this situation, there's 1 million common shares that are authorized, 900,000 that are issued, of which 100,000 are in treasury. So they're showing the total value, the consideration that was received for those shares when they were issued, all of them. And then down below, they're subtracting the amount that was paid to repurchase the 100,000 of treasury shares that are being held and waiting to be reissued. Okay, this concludes our introduction to Chapter 15, Shareholders' Equity.